when you see these kinds of movements where the paper price gets driven down and there's tremendous physical buying, it should be eye-opening. There's a battle going on right now where this could end up being one of the biggest delivery months, one of the top 3 biggest delivery months ever, and at the same time...
You're watching Silver News Daily. Subscribe for more.
They told you the system was stable. They told you silver was just a boring industrial metal. But right now, something massive is unfolding behind closed doors. And it's not a theory. It's happening. October 2025 just saw 38 million ounces of physical silver ripped out of the Comex vaults, making it one of the biggest delivery months in history. At the exact same time, paper silver prices are mysteriously dropping in thin overnight sessions, while massive institutions are panic buying physical metal like it's their last chance. Morgan Stanley, Bank of America. These aren't retail investors chasing memes. These are the biggest players in the game, and they're not just placing bets. They're making moves that suggest one thing. The paper silver market is finished. And here's where it gets even more disturbing. While the price is pushed down artificially, the physical metal is disappearing at an unprecedented rate. We are witnessing a historic dislocation between paper and physical silver, and the consequences could be seismic. For decades, silver has been suppressed by complex games played in shadowy corners of the market. But now, the cover is slipping. A run on physical metal has begun, and the vaults are being drained in real time. You won't hear this on mainstream news. You won't read it in your feed. But something is unraveling, and if you're not paying attention, you'll miss the most explosive wealth transfer silver has ever delivered. Why now? Why are the banks buying metal and suppressing the price at the same time? And what happens when the last ounce leaves the vault? Stay with me, because we're diving straight into the heart of the Comex meltdown.
Relevant. It's relevant because this is almost triple what was posted for delivery in October on the first day notice. In other words, most of the people who stand for delivery on Comex will do so on the first day notice. But what we have been seeing is deliveries like in gold that are 93% higher for the month than posted on the first day. This is contracts that are bought during the delivery month that instantly deliver, and they're much more difficult to analyze when you're trying to look at the Commitment of Traders report. But it's also very bullish in my mind. And as an example, between October 17th and October 20th, which I think would have been Wednesday to Friday, 6,000 contracts were written for immediate physical delivery in gold. And each of those were daily records for this point in the delivery period. And so, in essence, what we saw in my mind last week was driving down the paper price and immediately delivering contracts for the current month. They would drive down the December paper price, the futures, and stand for delivery and an immediate contract in October. So what was interesting to me about it as well was some of I think it's Michael Lynch, I think is his name, I'm pretty sure. Sorry, Michael, if I got that wrong, but I think that's who it is. And he writes a report dealing with Comex, and he talked about the footprints that he saw, that the two entities that, first of all, on, I want to say Wednesday or Thursday night, the price was driven down after New York had closed. And it was driven down in between New York and China, Asia, where there's virtually no liquidity, where no rational trader would ever dump metal, copious amounts, all at once into a very thinly traded illiquid market. Period. No one would ever do that. They did. And it's done for effect. Specifically for effect, to drive down the price, to guarantee the absolute worst settlement, the way that it should have been done. And when the mainstream talks about this, they neglect to tell you, well, by the way, it was all dumped in the middle of the night or, after New York trading. That would change the...
The Comex was never supposed to break. For decades, it stood as the beating heart of the global silver market, where contracts were traded, prices were set, and the illusion of supply was maintained. But that illusion is cracking, and October 2025 may be the moment history remembers as the beginning of the end. With 38 million ounces delivered in a single month, the vaults are being drained faster than they can be restocked. To put it into perspective, this isn't just a busy month. It's potentially one of the top 3 physical delivery events in Comex history. But here's the catch. These deliveries aren't being made in some kind of healthy, balanced market. They're happening while paper silver prices are falling. In other words, we're seeing record demand for physical metal, even as the price, on paper, appears to be declining. That's not just a red flag. That's a system in distress. What's even more alarming is the growing evidence that this isn't organic. Overnight, in illiquid trading hours, the price is repeatedly smashed down, only to see surges in physical buying the moment markets open. It's as if someone is trying to buy silver without triggering the alarm, but the alarm is ringing anyway. Every massive contract filled, every ounce withdrawn from Comex storage, is another step closer to a full-blown supply crisis. And it's not just retail stackers causing the drain. These are immediate delivery contracts executed by players with serious capital. It's not normal, it's not random, and it's not sustainable. The entire mechanism of the paper-silver market, where 100 claims can exist for every real ounce, is now under siege by its own internal contradictions. The math no longer works. The trust is evaporating. And Comex, the institution that once controlled the flow of silver, is being outpaced by a rush of physical demand that refuses to be ignored. So, who's behind this historic raid on the vaults? Who has the power, the urgency, and the motive to drain tens of millions of ounces under the radar? The answer takes us straight into the belly of the banking system.
Moment and some of the things that I found interesting about it. But I mean, look, first and foremost, the long-term case for gold and silver is crystal clear, as far as I'm concerned. You have central banks, foreign governments will continue to buy gold and silver now, unless there's a fundamental change in the attitude of this country, in particular Congress, towards the U.S. budget deficit and the nonstop continued deterioration in our fiscal condition and our fiscal sanity. Our fiscal irresponsibility is off the charts. And you can see that by the continued shutdown of the government. And I think there'll be volatility. Look, this is a game where, largely because a lot of things that we've been talking about since 2020, when I started talking to you about the deliveries that we saw, those were the beginning signs of a system that is all about paper promises, rehypothecated paper promises coming unraveled, where countries and sovereign wealth funds and very plugged in individuals and groups realize that it is indeed the Achilles heel of the entire system, and they would rather, I think, slowly exploit the metal and the commodities out of the system before there is a mad dash for them. And you know, a lot of people in this country, instant gratification isn't fast enough, and we've seen that with the rise and proliferation of cryptocurrencies and stocks like Nvidia and Apple that have defied gravity. One would say, well, why don't they just come in and buy it all up? And because you would see the strains that we're seeing right now in the LBMA, you would have seen them blow up instantly. And so this is a something that is not only coordinated, but also methodical, very well thought out, and done so little by little. But I think that when you see the stuff that's going on, where in October already, almost 39 million ounces of silver have been delivered to the Comex. The phrase is issued and then stopped, which means taking delivery. Whether or not they leave the Comex is irrelevant.
Morgan Stanley and Bank of America aren't just names on a chart anymore. They've become central players in a game that's rapidly spiraling out of control. These giants, once comfortable manipulating the silver price through leveraged paper trades, are now executing massive physical raids. But this isn't a simple pivot. It's a signal. A shift of this magnitude from some of the most powerful financial institutions on Earth means one thing: the rules have changed. Think about it. Why would banks that have spent years shorting silver suddenly turn around and start buying physical metal in bulk? It's not retail panic. It's not hedge funds chasing trends. This is premeditated, strategic, quiet. While the price is artificially pushed lower in the paper markets, these institutions are taking full advantage of the chaos to grab real ounces at suppressed prices. It's the financial equivalent of setting a house on fire, then buying it for pennies while everyone else runs from the smoke. And the scale of this operation is staggering. We're not talking about a few bars here and there. We're looking at record-breaking delivery contracts executed with surgical precision. It's no coincidence that SLV, one of the largest silver ETFs in the world, is seeing 84 million shares shorted, representing about 15% of its total float. These institutions aren't just manipulating the price, they're actively covering their positions by draining the physical market before the real breakout hits. This kind of behavior doesn't happen in healthy markets. It happens when insiders know that something big is coming, something that could permanently alter the silver landscape. And make no mistake, this isn't just about profit. It's about survival. When the world begins to lose faith in fiat currencies, when debt spirals beyond control, and when trust in the system vanishes, physical silver becomes more than an asset. It becomes a shield. The banks are not preparing for silver to go sideways. They're preparing for an event, a reset, a moment when the market can no longer pretend that paper and physical are the same thing. And when that moment arrives, those left holding digital contracts will learn the hard way what unallocated really means, because the banks are already positioning. The question is, are you?
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active.
The banks aren't the only ones panicking. The U.S. government is sprinting toward a fiscal cliff, and the numbers are staggering. In just 71 days, the national debt ballooned by $1 trillion, pushing total obligations past $38 trillion. That's not a trend, it's a collapse in slow motion. And when trust in the currency erodes, capital doesn't wait around, it flees. Into real assets, into protection. And silver, alongside gold, is where that capital is rushing. The Fed, after years of aggressive rate hikes, has flipped. The pivot back to pause rate cuts in 2024 and 2025 is a desperate attempt to keep the system afloat, but all it's doing is accelerating the fire. Real yields are falling, the dollar is weakening, and inflation isn't dead. It's just simmering under the surface, ready to roar back the moment the next crisis hits. That's why central banks are buying gold at historic levels. But it's not just gold anymore. Silver is now being scooped up by major institutions and private investors who see the writing on the wall. And here's the part no one wants to say out loud. The debt can't be paid back. The system has passed the point of no return. With interest payments exploding and deficits widening every month, the only solution left is currency debasement. More printing, more stimulus, more manipulation. And every time the dollar is weakened to prop up the illusion of stability, silver becomes stronger, not just in price, but in strategic importance. Because silver isn't just a hedge against inflation, it's an escape route from a crumbling financial order. It's liquid, it's tangible, and it's outside the control of the monetary alchemists engineering this collapse. And as confidence erodes, the velocity of demand will accelerate. The smarter money isn't waiting for the headlines. They're front-running the crisis now, before the retail crowd catches on. We are watching the early stages of a monetary reset, and silver, once dismissed as a relic of the past, is now being rediscovered as the lifeboat of the future. But this story isn't just about economics. It's about something much more dangerous brewing just beneath the surface, an industrial demand storm that's about to collide with a supply chain already pushed to the edge.
Or seeing, as an example, China building its own financial plumbing to get around the U.S. dollar system because it's no longer trusted. And, we focused a lot on Enbridge, but the CIPS system, the cross-border interbank payment system, which is China's version of SWIFT, is, in my opinion, the rails to what the Enbridge system will be. It's over 185 countries already are using CIPS to settle, including the Asian countries, which we've talked about before, which are 35% of global GDP right now, and China's biggest trading partner, twice the population of the United States. But the kicker is that once countries accept payment in yuan, like Russia sells oil or Brazil sells soybeans, they don't have to just sit on stacks of Chinese yuan. Through the Shanghai Gold Exchange, those yuan balances are actually convertible into gold. And this means that exporters who don't want to hold yuan can take that money and they've earned and go right to the Shanghai Exchange and convert it into gold bars. It's effectively a yuan to gold backdoor. And the next vault, as we talked about, is being built in Saudi Arabia. And this is why you'll hear analysts talk about this petro-yuan to gold trade. Instead of taking dollars for any commodity, the yuan is now convertible into gold. It's not backed by gold, but it is immediately convertible into gold. In essence, the system is finding an alternative to the dollar-based system, which since 1971 has only been backed by trust and confidence. And you can see that that's slipping on many levels. And so I do think that this is the underlying reality that isn't getting better, and nor is our fiscal responsibility. We are at 123% debt to GDP. Most of my career, any country at 100% would be considered a banana republic. And in just 71 days, we at 100 billion a week. How long can that go on? I think, people need to think about this. And maybe this is why you're seeing big money start to move into gold. The central banks have been front running it, and now you see Bank of America, Jefferies, Morgan Stanley, J.P. Morgan. They're all saying they're reassessing their outlook on gold all the way up to 25%. And when you see Michael or the big bond trader, the bond king for BlackRock, that Jeffrey Gundlach, say a 25% allocation to gold is not overweight. I mean, that's just unheard of to say that. Look, the deliveries off of Comex to me, really more than anything, are telling you that the most sophisticated traders in the West feel the same way. And if they're going to knock the paper price down, well, they'll cover their shorts and they'll stand for delivery. And we're seeing that. It's an emotional thing to see.
Silver isn't just a financial asset. It's the engine behind the technologies transforming our world. And that engine is running hot. In 2024 alone, silver demand from photovoltaic solar panels hit 232 million ounces, a staggering 20% jump from the year before and nearly doubled in what it was just 2 years earlier. This isn't a spike, it's an industrial revolution, and silver is its lifeblood. Think about what that means in the context of a supply chain already stretched thin. Solar panels, electric vehicles, AI servers, semiconductors, every one of these sectors depends on silver, and none of them have a viable substitute. It's not optional, it's required. And in a world racing toward decarbonization and digital expansion, demand is only going one direction: up. Forecasts show that by the end of 2024, 58% of all silver mined will be consumed by industrial uses. That's not just high, it's unprecedented. And unlike investment demand, which can fluctuate with market sentiment, industrial demand is sticky. Governments are passing mandates. Corporations are locked into production schedules. These aren't trends that reverse because of a dip in the price chart. What's more alarming is that industrial users are now being forced to compete with investors for physical metal. This has never happened on this scale before. Tech firms need silver to function. Manufacturers need it to survive. But when institutions and sovereigns start pulling ounces out of circulation, inventory doesn't just tighten, it vanishes. And the implications are enormous. Because when supply gets pinched, industrial buyers can't simply wait it out. They pay the premium. They secure long-term contracts, and they outbid everyone else. That's what we're already starting to see. Industry scrambling for supply while the banks hoard physical metal in silence. But if demand is surging across all fronts, and the vaults are being drained, the natural question is, why isn't supply keeping up? The answer is even more chilling. It's not that miners won't increase production, it's that they can't. Here's the cold truth about silver mining. It's broken by design. Over 72% of all silver doesn't even come from primary silver mines. It's a byproduct, extracted during the mining of other metals like lead, zinc, copper, and gold. That means even if silver prices surge, producers can't just ramp up output overnight. They're dependent on entirely separate markets with their own cycles, incentives, and constraints. This is what makes silver's supply chain so uniquely fragile. The industry doesn't respond to price signals the way oil or gold does. New primary silver mines take 10 to 20 years to develop, and even then, the returns are marginal. The all-in sustaining costs of mining range between $12 and $18 per ounce. But miners aren't piling in, not when exploration budgets are shrinking and regulatory hurdles are rising. Take Mexico, the world's top silver producer. In 2023, they imposed a 7.5% mining tax on precious metals. That one move alone sent shockwaves through the industry and stifled production forecasts. Even with Mexico pumping out 189 million ounces that year, global supply can't keep pace. Add to that declining ore grades, environmental restrictions, and political instability in key regions like Peru and Chile, and you're looking at a sector that's running on fumes. This structural inelasticity means that even if silver hits $100, we won't see a flood of new supply. The infrastructure isn't there, the investment isn't there, and the timeframes are far too long. This isn't like flipping a switch. It's like trying to steer a cargo ship with a canoe paddle. So while demand races ahead from both industrial and monetary fronts, supply remains stuck in the past. And the tighter the market gets, the more distorted the pricing becomes, especially when manipulated through paper contracts that have nothing to do with real-world availability. We're looking at a setup where supply can't rise, demand won't fall, and price suppression is the only thing holding back total chaos. But even that suppression has its limits, because buried deep inside this broken system is a flashing signal, an ancient market ratio that's narrowing fast. And when it breaks, silver won't just surge, it'll slingshot.
Yes, it's shares. So the shares are being driven down, which affects the price, but yet we're seeing, as they drive the paper price down, massive deliveries in both gold and silver this month. It's a very interesting, hard to decipher market. But, when you see these kinds of movements where the paper price gets driven down and there's tremendous physical buying, it should be eye-opening. And at the same time, when you look at, them shorting SLV, it's much more difficult to point fingers at who's doing it when it's not done directly through the Comex. And you should never be able to grotesquely short, as Ed Steer says, a proxy like SLV, but it certainly has its impact on the price. And, again, think about this. We added $1 trillion in 71 days. That's just unheard of, and it's unsustainable. And our debt is rapidly approaching 130% debt to GDP, where other than Japan, no one's ever come back from that. And, the difference with Japan is that, they're not the world reserve currency. They have a budget surplus, and their debt not only is contained with yield curve control, it's mostly owned by the hedge funds, the government, and the people. And so they can get away with it. We can't. And if you're holding treasuries and you see the fiscal irresponsibility mounting Yet at some point, this debt does become a problem, and the people who point to it not being a problem, I think, are missing the picture.
The gold to silver ratio has long been one of the market's most powerful signals, and right now, it's sending a warning that few are paying attention to. Historically, when this ratio stretches too far, it snaps back with force. And every time it does, silver launches. In 2020, the ratio spiked to a jaw-dropping 120 to 1, signaling extreme undervaluation. Today, it hovers between 75 and 85 to 1, still high by historical standards, but tightening fast. That compression is the spark before the explosion. Here's what makes this ratio so important. It's not just a number. It's a psychological indicator, a reflection of sentiment, scarcity, and relative value. When the ratio is wide, it tells investors silver is being ignored, overshadowed by gold. But when it narrows, it signals silver is waking up, and the gains that follow can be violent. In both 1980 and 2011, as this ratio tightened, silver didn't just rise, it went vertical, outpacing gold by multiples. But what's different now is the backdrop. In past cycles, it was mostly about monetary policy and investor appetite. This time, we have all of that. Plus surging industrial demand, collapsing supply, record Comex deliveries, and systemic debt risk. In other words, every pressure point is pushing the ratio lower, and the lower it goes, the harder silver runs. And smart money knows this. That's why, as gold flirts with all-time highs, silver is still lagging. For now, it's being held back, not by fundamentals, but by manipulation and inertia. And when that dam finally breaks, silver doesn't climb politely. It explodes. Because the gold-to-silver ratio isn't just a measurement, it's a countdown. The moment silver starts to outperform, the floodgates open. Retail investors pile in. Institutions follow. And all of the paper suppression, all of the synthetic supply games, collapse under the weight of real-world demand. But this isn't just about ratios. It's about the mechanisms that keep silver under lock and key. And what happens when the lock finally snaps? Because as we'll see next, the paper market itself is already beginning to fail. The paper-silver market is an illusion, and it's starting to unravel. For years, the entire structure has been propped up by one simple trick: create more contracts than there is metal. On Comex, it's not uncommon for there to be over 100 ounces of paper silver for every real ounce in the vault. And for a while, that game worked. As long as no one called the bluff, the illusion held. But now, people are calling it, and the system is cracking under the pressure. Take SLV, the largest silver ETF on the planet. As of October 2025, over 84 million shares are shorted, nearly 15% of its entire float. That's not normal. That's not hedging. That's desperation. It's a clear sign that institutional players are leaning on price suppression with everything they've got, even as they're quietly accumulating physical behind the scenes. They're playing both sides, pushing the price down in public while stacking metal in private. But this game is running out of room. Physical inventories are declining, Comex warehouse stocks are shrinking, and as we saw earlier, record physical deliveries are happening in the middle of a price drop. That's not just a dislocation, it's a systemic breakdown. The market is screaming for metal, but the pricing mechanism is broken. It no longer reflects reality. And here's where it gets even more dangerous. Retail investors still trust these paper vehicles. They think they own silver when they buy shares of SLV or futures contracts. But what they really own is exposure to someone else's promise. A promise that when the music stops, may not be backed by anything. Because the silver isn't there. It's been leased out, hypothecated, or simply doesn't exist. This is what makes the current moment so volatile. The paper market is being used as a weapon to keep prices artificially low, but the physical market is calling its bluff. And the moment that bluff is exposed, we could see the fastest repricing of any asset in modern history. Because when confidence in the paper-silver system disappears, it won't trickle down. It will collapse. And yet, the most powerful shift isn't just coming from traders or ETFs, It's coming from an entirely different corner of the global financial system, one that's quietly building a new monetary order, and silver is being pulled into its orbit.
Outcome. I think it invalidates the valid reasons. It was done for effect, not the way that it should have been done over hours or days, bled through New York where there's great liquidity to ensure the best settlement. Anyways, what I found interesting was he talked about the two big buyers that came in and drove silver price up into the green after being down $1 and gold about halfway up, because remember, when they drive the price down, the algorithms that control the hedge funds, they're not emotional, and if levels are breached, they just sell. So selling begets selling begets selling. But I found it interesting that he notes that both Morgan Stanley and Bank of America came in and were big buyers of physical as the paper price on the December contract was driven down, which drives the spot price way down. They issued October immediate delivery contracts, which were setting records for massive amounts. Now, the reason I think it's interesting is we've talked about Michael Hartnett and for the lead analyst for Bank of America that has the big high-price newsletter. I think it's north of $10,000 a year for institutional traders, and also the chief investment officer of Morgan Stanley have been in the news lately, where Morgan Stanley says no longer 60-40, 60 stock, 40 bonds, it's 60-20-20. Sell half your bonds, buy gold. And Michael Hartnett says, no, it should be 25, 25, 25, 25, stocks, bonds, short-term treasury, and gold. And so here you have two very large commercial banks. And by the way, Morgan Stanley has been a huge seller of gold leading up to this, and all of a sudden they come in and buy over 600,000 ounces, where you have these big banks who never talked about gold at all, any allocation, now saying as much as 25%. This was done for effect. And it was done either to cover shorts, to take possession of physical, or to rattle the bushes and make people think all of the things that the mainstream said, a lot of which were valid. Gone up 9 straight weeks in a row, was overbought, in need of some sort of a flush. Okay, I believe all of that. And if it had been done properly, the right way over time, instead of all at once, when the market was liquid instead of when it was illiquid, well, maybe I'd believe that, but it was done for effect. And so I would suspect after I research tonight or tomorrow morning what happened today, we'll see similar footprints in the snow that will talk about, this exact same thing.
I want to underscore two things that you mentioned prior to this.
While Western institutions scramble to cover their tracks, a new global order is quietly taking shape. And it's not being built around dollars. It's being built around real assets, and silver is starting to play a strategic role in that shift. The BRICS nations, Brazil, Russia, India, China, and South Africa, are now accelerating efforts to de-dollarize the global economy. And at the center of that plan? Precious metals. Gold-backed trade settlements are already underway. But silver, with its unique dual status as both industrial necessity and monetary metal, is now in the crosshairs of sovereign accumulation. This isn't a theory, it's happening. Central banks are on pace to buy 900 tons of gold in 2025 alone, and silver is increasingly being discussed as a parallel reserve asset, especially among nations looking to diversify away from U.S. debt. Why? Because the credibility of the dollar is evaporating. A $38 trillion national debt, a collapsing yield curve, and growing geopolitical instability have turned the greenback into a liability. And countries holding dollar reserves are no longer waiting for the collapse. They're hedging against it. At the same time, silver offers something gold can't: utility. It's not just a store of value, it's a strategic commodity. The countries leading the energy transition, China, India, Brazil, need silver for solar, AI, infrastructure, and EV development. And they're not going to rely on Western vaults or manipulated paper markets to get it. They're buying direct. They're forming new exchanges. They're setting up bilateral trade agreements where silver is no longer just a commodity. It's leverage. And it doesn't stop there. The arbitrage between Comex and London is widening. Premiums are rising in Asia. Metal is moving in bulk across borders, often with little media coverage. This is the kind of silent shift that only becomes obvious in hindsight, after the price has already exploded. After the old system has failed, the silver shortage isn't just an industrial crisis. It's not just a trading anomaly. It's becoming a geopolitical event, a monetary realignment. And when you combine all of this, the physical drain, the supply crunch, the collapsing paper market, you're left with only one possible outcome. Because the silver market isn't just stretched, it's primed. And what's coming next will redefine the price of silver and what it means to the global financial system.
Fiscal irresponsibility. The U.S. government added $1 trillion to the debt in 71 days last month. 71 days from 37 to 38 trillion just recently. And the interest cost on the debt is mounting at a level where, it's now the largest budget item. And none of this includes the unfunded future liabilities, which are so large and disgusting that I don't know how you pay them off without devaluing the currency. Ultimately, that is how it has to be done, as far as I am concerned. But yeah, this is a deal where the shipments out of both the Comex in New York, or the shipments into Comex in New York or out of, some of it stayed in there, will be roughly 38 million ounces this month of silver, and that will put it on pace to be one of the biggest delivery months ever. This is a deal where at the same time you have one of the largest short positions ever on SLV. Over 80 million shares are naked short to affect this. There's a battle going on right now where this could end up being one of the biggest delivery months, one of the top 3 biggest delivery months ever. And at the same time, it's getting hammered. And SLV has an 84 million ounce short position or share, 84 million shares. I guess I don't know if that's ounces or shares. For the last, it's 83.86 million, represents 15% of all outstanding shares. So
This isn't just a price forecast. It's the endgame. The silver market is detaching from the system that suppressed it for decades. And once it breaks free, there's no putting it back. Every signal we've covered, the record Comex deliveries, the institutional panic buying, the crushing debt spiral, the industrial vacuum, the mining gridlock, the collapsing gold-silver ratio, the paper market unraveling, and the geopolitical realignment, they all point to one inevitable conclusion. $500 silver isn't a wild prediction. It's the logical result of a broken system running out of options. And it won't be a smooth ride. It'll be chaotic, volatile, and violent. Price suppression doesn't end gently. It ends in a surge. When the last ounce leaves the vault, when institutions are forced to buy at market instead of manipulating from the shadows, when the public finally realizes that paper contracts aren't metal, the revaluation will be unlike anything we've seen before. This isn't financial hype. It's a blueprint, a cascade of cause and effect playing out in real time. And while most of the world is asleep, quietly trusting a system that's bleeding out, the smart money is positioning for what comes after. Because when silver breaks free, the question won't be how high it can go, it'll be how fast. If you've made it this far, now is the time to make sure you're informed and prepared. Subscribe to stay ahead of what's next. And remember, this is not financial advice. Always speak to a professional before making any financial decisions.